Next up, we're diving into something fascinating, a super simple investment strategy that, believe it or not, has beaten the Nasdaq for over a decade. Now, I've been in this game since, well, let's just say I remember when brokers still wrote confirmation slips with carbon copies. And you know what? The best strategies aren't always the most complicated ones. This one is so basic, it takes about 5 minutes a year to manage. Seriously.
Wow. 5 minutes a year? That sounds almost too good to be true. What does that even look like? I mean, beating the Nasdaq is huge. I'm always hearing about how difficult that is.
It's amazing, isn't it? Well, it centers around two ETFs, exchange-traded funds for those just starting out. Think of them as baskets holding a bunch of different stocks. This strategy uses BTL and TQQQ. BTL is an anti-beta ETF, which sounds fancy, but essentially it tries to make money when the market goes down. It's like having built-in insurance. And TQQQ, that's where things get interesting. It's a 3 times leveraged Nasdaq fund, meaning it aims to amplify the daily returns of the Nasdaq 100 index by 3 times.
Okay, anti-beta, insurance, and then tripled leverage. So if the Nasdaq goes up 10%, TQQQ tries to go up 30%? That sounds pretty powerful, but also risky. I'm already getting a little nervous just thinking about that.
You should be. It is risky. Leveraged ETFs aren't for the faint of heart, but here's where the magic comes in, and it's all about discipline. Once a year, on January 1st, you rebalance your portfolio to get back to a target weight of roughly 67% BTAL and 33% TQQQ. That's it. You sell some of whatever has done better, buy more of whichever is lagging behind, and then you leave it alone for another year.
So if the Nasdaq had a really good year, TQQQQ would be way up, and you'd sell some of that to bring it back down to 33%. And then buy more BTL, which probably didn't do as well.
Exactly. And this rebalancing is key. See, those leveraged ETFs like TQQQ, they suffer from something called volatility drag. Every little bounce and dip eats into their returns if you're constantly tinkering with them. By only rebalancing once a year, you let the portfolio ride long-term trends instead of getting whacked by short-term fluctuations. It's like, think of it like this. You don't want to trim your hedge every single time a leaf falls off, right? You wait for a bigger pruning session so the whole thing stays healthy.
That's a really good analogy. But still, that 3x leverage, what kind of returns are we even talking about? The article says an 18% CAGR since 2012. That's incredible. Is there any chance it's just luck?
Well, luck plays a role in all investing to some extent. But 18% compound annual growth rate for over 10 years is no fluke. They backtested it extensively and it holds up pretty well. The maximum drawdown, meaning the biggest loss from peak to trough, was around 28%. Now that sounds scary, but compare that to QQQ, which tracks the Nasdaq directly, plunging much further in 2022. BTAL helps cushion those blows when things get rough.
Okay, so it's not immune to crashes, just less bad during them? What about swapping TQQQ for something a little less aggressive? The article mentioned QLD.
Smart question. Yes, they did mention that. QLD is a 2 times leveraged Nasdaq fund. It's still leveraged, but half as much as TQQQ. That would likely lower both the potential upside and the downside risk. You'd probably see slightly lower returns overall, but also less volatility. Honestly, it really comes down to your risk tolerance. I remember back in the late 90s during the dot-com bubble, people were throwing money at anything with a dot-com at the end. Leverage then felt invincible until it wasn't. It's easy to get caught up in momentum, but always know what you're holding and how much risk you're taking on.
That's terrifying to think about. So, the strategy, it kind of flies in the face of everything I thought investing was supposed to be? Like constant analysis, picking individual stocks, timing the market.
Exactly. Which is why it's so interesting. It proves that sometimes simplicity and discipline are your greatest allies. The biggest challenge isn't what you buy, it's sticking to a plan when everyone else is panicking or getting greedy. There's an inherent human bias against things that seem too easy. We think there has to be a catch. But this strategy, well, it's a compelling argument for letting the system work and resisting the urge to tinker.
Wow. It almost makes me want to reevaluate everything I'm doing right now, although that does bring up something completely different. What about taxes? With all this buying and selling each year, that sounds like a nightmare on tax day. Is there any way to minimize those costs?
Excellent point. You're thinking like a seasoned investor already. Haha. Yes, the annual rebalancing will trigger capital gains or losses depending on your performance. Holding these ETFs in a tax-advantaged account like an IRA or 401 would definitely help mitigate those taxes. That's something you'd want to discuss with a financial advisor. I always say taxes are just another cost of doing business, but smart planning can minimize them.
Okay, so tax-advantaged accounts, annual rebalancing. I think I have enough to start digging into this further. It's still a little scary. That leverage is definitely something I need to wrap my head around, but the potential upside and the simplicity are really appealing. Maybe I can beat the Nasdaq with just 5 minutes of work per year.